thank you all for joining us for Venture Crush today. I'll just go through a couple of quick things and then we'll get underway. We're going to drop some links for panel bios so that you can check the folks out in greater detail. We would encourage you to use the chat actively and connect with folks via LinkedIn. And as always, we use closed captioning and want to make sure that folks feel welcome and included. And we'll drop a couple of other links to things, including some upcoming events and stuff. If you have questions, you're welcome to drop them in the chat as well. So on behalf of Lowenstein, Sandler, and Venture Crush, welcome. And what we're going to do, just so that people aren't too surprised, is we'll do a little bit of the backgrounds of each of our panelists, and then we will talk a little bit about funding and also about building a culture and attracting and retaining team members. So with that, we can kind of start in alpha order with Addie. And Addie, I just want you to know that it was a challenge to invite you because you've publicly disclosed your fondness for the Boston Red Sox. And we are a New York-based group, and I'm a New Yorker, so you're not the only thing that's off limits today is saying anything positive about the Boston Red Sox, or really Boston. But
got it. It's gonna make it tough, but I'll do my best.
I am crushed too. We're Boston based, Addie, I've got your back.
All right, let's strength in numbers here, Ed.
It's a rebellion. Yes, Rudina, I do know that I wanted to get through the Boston in one fell swoop. This is it for Boston for the whole year for Venture Crush, just so that we're clear.
Saving up.
Yeah. Yeah, you could look at it as saving it up. So Addie, you worked for a couple of generals and then
I did.
And then went off on your own, and you've lived in a bunch of different places. Can you give us a quick thumbnail on your background?
Absolutely. So I have to start. I'm from Newton, Massachusetts, right outside the great city of Boston. And I went to Princeton for undergrad and then started my career in venture and growth investing. So I started out at Goldman Sachs in the special situations group, investing the firm's balance sheet capital into mid-market and growth tech companies. And then spent a few years at the first of the generals, General Atlantic, working with Anton Levy in what was then called the Internet and Technology Group. Also spent a year in the firm's London office covering Europe and Israel and the Middle East, which was both a lot of fun and also illuminating to break up the US-centric perspective I'd had for so much of my career. And then moved to General Catalyst. I really loved working with earlier stage founders and companies, and made a number of increasingly fintech focused investments at GC into companies like Monzo, Shift Technology, and co-led the Series B of Rapid out of Israel while I was at GC. And then left in the summer of 2019 to start Avid Ventures, which is a Series A and B focused early stage venture firm. We invest smaller collaborative checks alongside top tier investors and then double down into our emerging portfolio winners. We've done that with two companies so far, Alloy, a great New York based company, and Pento, which is over in the UK.
And are you focused on stuff in the UK, in Europe more broadly? Are you should we think of you as a borderless fund when it comes to investing, or is it really just the three core markets well, States, Europe, Israel? What's the
core markets? We say North America, and we've also made two investments so far in Mexico. So North America, Europe, and Israel. And we're doing that with a team of three who are all based in New York, but as we all know, everything is quite global these days. So we leverage our very close relationships and networks across those geographies and are quite focused throughout.
And is Mexico going to be a core focus? It's a pretty exciting market. I know we've done a whole bunch of deals in Mexico, and my colleague Juan Soto has us really pushing into more LATAM deals on the Lowenstein side and on the first close side. Carolina Huaranca Mendoza, who's one of the GPs at First Close, is very eager to see everything we can in LATAM.
I would not say focus for us, although we've been thrilled with the founders that we've partnered with and have gotten to know in Mexico and broader LATAM to date. So I would say you'll potentially see more in fund too.
Okay, and on the personal front, you've talked a little bit in interviews about your personality showing up 2D on a 2D screen. And you have some hacks to try and correct for that. I have not found that to be the case with you, but you're also trying to take every meeting you can in person. And how's that going? And what are some of the
Going
hacks?
great. Well, some of the hacks are just actually getting out of New York and going to other cities. So I was in Tel Aviv last week for the rapid board meeting, seeing one of our companies balance there. I'm going to LA next week for company meetings in the Upfront Summit. And the magical thing about traveling is that your meetings become entirely in person, because why would you go to another city if you're just going to sit on Zoom? So that has really, I think, helped me sort of feel like we're in more of the before times. And it's been quite energizing as an extrovert. I really do feed off of 3D live energy. So that's been, I think, a great way to continue to try to do as many in-person meetings as possible. And I also in New York try to see founders who are here in person as much as possible. Although I did have a Zoom a couple of weeks ago with a founder who literally works in an office a couple floors above me in my apartment building. So that was a very interesting experience. I was like, that molding looks very familiar.
And you also have a way of kind of fast forwarding, or you gave guidance about fast forwarding into, like, if it's your first meeting, you want to skip everything and pretend it's your fifth meeting. How do you do that, particularly if you're not as extroverted as you are?
So it definitely takes practice, but I try to, and this is advice I give to folks on this topic as well, is to really just try and imagine this person you're meeting for the first time. Like really just try and imagine it's the fifth meeting. You've had coffees, you've had a meal or two, you've already gotten all the other stuff out of the way, and just trying to show up as your authentic self as much as possible, and really not second guessing or overthinking what you're about to say, but just being, sounds a little trite, but just being yourself as much as possible and expressing what you think, what you want to say, and creating the intimacy and creating the relationship that I have found is what can help folks sort of reveal their true selves faster than it might otherwise take. And let's face it, none of us really have the time to waste in a lot of those steps. So it doesn't mean that also everyone is going to be the right fit for you, whether it's a founder investor fit or co-investor fit. But by actually accelerating, showing your true colors and your true self, it'll often help the other person do the same. And you can find out even faster if it is going to be that kind of true love fit.
And so speaking of great fondness and fit, Jacqueline Hester of Foundry, who led the firm's investment in Avid, wrote, and I really think she was kind of tout-splaining her firm's, not a word, by the way, I know that, her firm's investment in Avid, and said founders with whom we spoke raved about Addie and how helpful she's been to them. And while you might think that that sounds like a little generic, that you've been helpful, it's the case apparently that you have like parachuted in to be a substitute CFO at companies that you've invested in while also raising Avid. That's a little crazy, no?
It is, it can be, but it is also our special sauce. And it's candidly what I love most about partnering with our founders is getting to work truly as an extension of their teams. So, you know, I'm glad to hear that from Jacqueline and from our founders, really, because we do say our founders are our best references. We get to know them, we get to know their teams really, really closely before investment, but especially after we've invested. And I think that is what differentiates us as a firm.
Great. Okay. And we will come back. I want to talk to Phil a little bit about the military. But before we get to the military, which Phil, you did not end up in, as I understand it. Phil, you and I met in 2003 at a venture event. So you were not a newcomer to venture. I know we have the same haircut and we can trade, stylist tips later. But you gave a little bit of insight in various interviews about what's changed in the last 23 years that you've been a VC, and you've been a founder, you've been an angel, and now you've started this fund. Can you talk a little bit about your background and the nearly quarter century that you've been in venture?
Sure. And Ed, thanks for having me. Just really excited to participate on the panel. So I started in venture back in 1999. So I was with a fund based in DC. We had about 650 million under management. I invested about 100 million of that. So I led 16 investments, worked on a total of 20, had a number of IPO, M&A exits, et cetera. Sort of in the late 90s, it was enterprise software where I was focused. And then as things shifted to the cloud, I did a lot of internet infrastructure. And then over time sort of evolved into SaaS based investing. Also co-founded a company while I was with that fund, venture backed in the education space that I ran for a number of years. Then moved to chairman of that back in 2017 and started to invest on my own account. Did that for a few years, and that's when I started to co-invest with my now co-founder of Ardent, and we started to do seed investments together, and that led us to start the fund. In terms of what's changed about venture, I'd say a number of things. Just looking back, let's say even 10 years. I'd say, first, just the market TAM that venture capital as an asset class is going after has grown significantly. So I'd say even in the last 10 years, it's probably grown at 10x. As software is just eaten in now to every industry and has moved up the stack, with things like AI and other forms of automation that I know Radina is spending a lot of time on. Also, just the global adoption of technology has just driven the market TAM as well. And so, the adoption of mobile globally, fintech globally, social media globally has just created a market opportunity, literally from inception for a lot of these companies to go global. And it just wasn't like that 10 or 15 years ago. So market TAM has grown. Dollars have gone into the asset class given that growth. Right. But it tends to be concentrated within large funds. And so, the size of, some of the large venture firms now, even ones that consider themselves to be Series A, has just grown significantly. And as a result, the size of that Series A check has grown as well. And so 10, 15 years ago, Series A was, $5 million, $8 million. Now it's 20, 30, 40, $50 million. And, it's just changed the dynamic because, given that market TAM, given the dollars, there's a focus on very, very, very high growth companies, and a lot of dollars are sort of flowing into those. I'd say the next thing that's changed is just, 10, 15 years ago, you had a number of folks who were in firms. The firms were just, individuals doing deals. Now, and I'm sure we can all talk about this on this Zoom. In addition to that, everyone's building out platform, right? And the way folks think about platform, varies depending on strategy, but that's a key component to venture now as well. Another thing that's changing, I wouldn't say it's changed, is just the focus on diversity, right? So when I started in this business 23 years ago, I recall going to a National Venture Capital Association conference and going into a room with 3,000, 4,000, 5,000 people. And there were probably less than 5 African-Americans in the room, not to say venture capitalists, because some were service providers. And just gender diversity was very low as well. I'd say there's been some improvement, but still a long way to go. I'd say what has changed over the last few years is the focus on the issue. And so, a lot of conversation, and the work you're doing at First Close is huge as it relates to it as well. So those are some of the changes that I've witnessed.
And you're saying a lot of discussion, but the numbers aren't moving quite so much.
Right. They're moving, and I think, quite frankly, this Zoom is a good representation, but it's still, the numbers are still very small, and, all of us can speak to that.
And we will definitely speak a little bit more about that, and the numbers as to women, also something that we're gonna spotlight. One of the things that you talked about in an interview was that you've always been empathetic, and that your experience having always been one of a few people in the room, like at that National Venture Capital Association meeting you're referencing, or that you were one of 2 or 3 African Americans at Carnegie Mellon's computer science program when you graduated, has given you a different lens on maybe empathy. And is that something that you think flows through in the way you're thinking about investing?
Absolutely. I think when you are an other, when you're not the majority, you often have to look at the world, not just from your perspective, but from the perspective of others in the room. It's what you have to do naturally, right? Because of the power dynamics that exist. And I've found that that perspective to be critically important in early stage venture capital, right? Because in early stage venture capital, your goal is to meet a founder who's a standard deviation away from everyone else. And often they're describing something to you that may be odd. It may not be, something that you've thought about. It may not be an idea that sort of fits nicely into the theme or thesis that you're thinking about. Think about hearing the pitch for Airbnb, at the pre-seed stage, right? It's couch surfing, like what? And so to really appreciate and understand opportunities like that, you have to see the world from the founder's perspective, right? You have to see the market opportunity from their perspective to get a sense for how big it can potentially become. You have to really understand the dynamics that they see in the market that lead them to believe that doing something as odd as they're describing to you is something that they feel they can do and build a massive company doing it. And so that empathy lens often will allow you to consider deals that others may not, because it doesn't fit in nicely to the buckets that they have. So I found that to be really helpful in pre-seed and seed investing.
Yeah, and just for context, because I know that there's also a lot of discussion around Black VCs as emerging managers. I love that you noted having put 100 million of other people's money to work as a VC before starting Ardent. And I know that you can't talk about your multiple on invested capital, so you can't confirm that your multiple is about 4x, meaning that you turned $100 million of LP money into $400 million of value, which is like Hall of Fame kind of numbers. So I won't ask you to comment on that. It's just an example of extraordinary performance and a really long track record of deploying 9 digits of capital, which really LPs should be eating up. So what I will ask you about, though, is you've described yourself as a practical joker and someone who's always telling jokes. And I would be curious to hear a practical joke that you have played in the recent past or been the victim of.
Oh gosh, that's a good one. You have to give me a second. I'm thinking about. Actually, I'll come back to that. Give me a second because I need to come up with a good one.
Okay.
Given the lead-in, you talked about the fact that I consider myself a practical jokester. I have to come up with a good joke in order to live up to the hype.
You do, and I wanted to make sure that I caught you completely off guard with it because, I owe you. So the last thing I wanted to ask you before we go to Regina and then Mike is advice or guidance that you got from your dad as he was dropping you off at Carnegie Mellon.
Yeah, it's a funny story. So, when I was in high school, I was more of a basketball player than I was a student, to be honest. And, my dad and I would go back and forth, back and forth, back and forth. And I ended up doing well on the SAT and some other things. And that enabled me to go to Carnegie Mellon. And, but my dad and I, had a bit of a contentious relationship back in high school. So we're going off to college. Like, I'm leaving the front door of my house and I'm walking outside. And right when I get outside the door, like, we're packing up the car to drive off and go to college. He looks at me, he says, congratulations, you're going off to Carnegie Mellon. I'm really excited for you. I really hope it goes well. But if it doesn't, you're not coming back here, you're going into the military. And that's what he told me. And that sort of stuck with me. And that was one of the things that sort of, caused me to focus quite a bit in college and do quite well.
And are you thinking about repeating that playbook of, there is no safety net?
No safety net for my kids, that's for sure.
All right. So Rudina, safety net, you came to the States when you were 15. And we'll get to your many years in venture in a minute, but you came here with your family, or you came here solo when you were 15?
Alone. I came alone. I came to go to high school. So, left my family and was placed with a local family here in the States, and skipped a grade of high school. So went straight to my junior year and then senior year, and then ultimately went to Wellesley. Yeah.
And had you spent a bunch of time in the States before you got here?
No. So I'm Albanian by background, and to many that may mean very little. But what that meant in the time that I came over to the US in the 96, 97 time frame, the country had just opened up. It used to be a former communist country and one of the most isolationist countries. So think akin to what we would envision North Korea to be like today. So it was my first everything, my first time on a plane, my first time leaving the country, and boy, did I come to a big country. So truly first many things.
And how did you acclimate culturally in the middle of high school? Did you use Addie's trick of fast forwarding to the fifth meeting? What was it like? Was it big culture shock?
Definitely a big culture shock from sort of the so I came on leftover Fulbright money. I was not a Fulbright scholar, but USAID leftover Fulbright money. And I went to Louisiana of all places. So big culture shock, a very polarized culture. And forgive me for all of, or any of you who might be from Louisiana, but on the educational scale, as I came to learn over the years, not one of the top ranking states. So a lot of adjustments as a young child, not to mention, language, I spoke English fairly well, but just a lot of learnings. And that is interesting. I will, if you'll indulge me, I'll label it as the immigrant mindset. Looking back now that I know what I know, and you're older and you're careful about risk taking and all that, I'm not sure that I knew at the time what I was going through, but there was one goal that was paramount. I couldn't fail. Because it was a huge sacrifice on my family's part, on my own part, and sort of just I carried the weight of the world and didn't know it at the time. And you look back and you almost sort of place a distance between that young teenager versus myself, although it's one and the same, and it has helped shape who I've become. But you learn to be the best at what you can and cut no corners or cut smart corners and ethical, stick with your ethics and really give it your 110%. So failure doesn't rest on your shoulders.
And so we're gonna come back to Wellesley a little later, but okay. Right out of college, it looks like you get a job at what was then the leading investment bank. And I'm guessing you got the job before March of 2000, because you started in like August of 2000. And that, to me, as someone who was doing tech deals at the time, means that you got a job in the hottest tech market of all time, and you started the job in the worst tech market of all time. And it was a deal focused job, which, like, oh my God, did they have anything for you to do? Or were you like, I'm back in Albania?
So it's so it's a fascinating experience. So for everyone else, what Ed is referencing is that I graduated in 2000 and joined, at the time, CSFB, or Credit Suisse First Boston's technology groups. I worked for Frank Patron's group, as the lingo goes, in the 2000s. And yes, by the way, that's that group and that experience on the upside is the genesis of my having caught the technology bug. But, you know, I recruited on campus because that's what you did. And there were multiple investment banks and tech, you know, that I got offers from, and tech had gotten my attention, and tech it was. So I joined that group. Interestingly, I had an amazing experience there, did a number of transactions because I worked out of the subgroup on communications equipment and semiconductors. So all through the correction, summer of 2000, all the way to really the correction of 2001 and beyond, we continue to have activities. So did follow-ons, did mergers, did convertible notes, got a very, very, very good experience in that regard, and a lot of learning. Got that learning, got also the learning of what happens when you get caught into a correctionary environment. One of my biggest learnings, again, is work ethic. Survived 6 rounds of layoffs. That group, when I joined, was 600 people. By the time I left, was fewer than 100. And I used to describe it as empty cube, empty cube, empty cube person, as we were kept shrinking down. So you learn a lot about that. And for someone like me, to your point, if I were one of the folks who would have gotten laid off, I had 60 days to leave the country because I was on a special working visa for a particular, class of people. And so it was very important that I nailed it and tried to do my best to do so.
And that's a remarkable story. You've also been a fairly prolific publisher of articles. So it's not just that you're, interviewed or cited in things, but you've written a lot. And one of the things I love about reading the material that you've put out over the years is that even when you're writing about AI or writing about frontier tech, you are weaving in policy and impact. And I want to reference 2 specific things that you've written. One of them was in 2017, where you were writing in TechCrunch, and you wrote about changing the dynamics of the VC industry. And I'm going to just quote a little bit, and then I'll ask you to comment, because here we are, 6 years later. People are up in arms after the recent reporting by The Information that 6 women entrepreneurs were sexually harassed by the managing partner of a VC firm. While the news is making headlines globally, the more substantive questions remain. What will happen when the buzz fizzles out? What has happened now that the buzz has fizzled out, and now that the particular perpetrator in that situation is listed a philanthropist and is, doing angel investing?
So let me bring it to the 30,000-foot level. I won't comment on the particular individual because it's simply unfair. I don't have all the facts.
Totally.
So I think we've seen a lot of change. I don't think we've seen enough change, but I think we have seen a lot of change. I think the Me Too movement, and at least on the gender dynamic side, has had a lot of impact. And unlike, I've been now in venture for, it's the beginning of my 18th year. So unlike years past when we paid lip service as an industry to gender and background diversity, today, I think, we're seeing real momentum around LPs putting, at least asking in diligence questionnaires, at least directing some dollars, always for performance, but also for performance driven by diverse backgrounds. And my view has always been that we're here to make money. If we wanted to run these as charitable organizations, we could have done something else and contributed in that manner. So do not confuse one's background, whether it's skin color, where they come from, gender, what have you, as a desire to get by in life, without success. Quite the opposite. And oh, by the way, we are looking, I think it was Phil who made the point of that one standard deviation. We're looking for that outlier out there. How can it be, whether it was all women, all white women, all white men, whatever the background, if we are so very homogeneous, how can we inherently have diversity of backgrounds, diversity of thought, and diversity of approaches to lead to better outcome? Our entire industry, at the end of the day, is about funding someone who sees the world differently, can drive that disruption, both from the idea point of view, but the execution piece as well. By default, that differently means differently in how we view them and who we are in viewing them and who we fund. So I'm an inherent believer that it's how our firms are composed and who we back and how we expand their teams that will lead to better outcomes. It is a normative issue, but for me, first and foremost, it's a business issue. And not doing so, it's not optimizing your returns for your LPs. And I think that applies to our entire industry as venture, and also the founders and how they build their management teams and beyond.
And we don't talk enough in venture about funding people who see the world differently, because if you've got the same observations as everybody else, you're not going to have that breakout success. And along those lines, I know that, the other piece of writing of yours that I wanted to reference now is—
Sorry, one point, if I may add, finish the thought. A lot of progress has been made. We are far, far behind as to where we need to be. So make no mistake, it's a journey, but we're nowhere near the destination. And even the little tricks that you see where post MBAs get partner labels because they are diverse, but they're not truly GPs, neither in their economic interest size, nor in their decision making, I think still need to be curtailed. So we have some ways to go. I just wanted to finish that thought.
No, that's a great point. Absolutely. And the last point before we go to Mike is, another thing you wrote about artificial intelligence and policy in 2019, you cited stats that an estimated 51% of domestic private companies valued at $1 billion or more had one or more founders who were born outside of the US, and 31% of venture-backed founders are immigrants. So also noting that immigrants are disproportionately represented at the top, right? And in 2019, there were far fewer companies that had attained $1 billion valuation. And I'm curious to know if you feel like you've gotten pushback being vocal as the managing partner of a venture fund on issues that are important to you, because in that TechCrunch article, you also kind of took on the Trump administration's immigration policy, which I appreciate. You taking that on. I don't appreciate his policies, but
so I try to separate my personal politics from the day-to-day operations and running of the firm. But we are who we are, and I think look, I think it even manifests around the fact that AI and how we invest in responsible AI. It's my day and morning and night. I'm investing in enterprise, so we didn't talk about what Glasswing does, but early stage investors, 78% of the companies we invest in, we're the first investor, and 100% the first institutional investor is that first $2 million check, and very much platform focused. So we're focusing on building the team and getting them customers. And we can talk more about that at some point. But I think being responsible in terms of how we harness talent and, not shutting the door on brain gain. That's the genesis sort of and the foundation of this country. And then also fundamentally being responsible for what we do forward on the AI side, thinking about ethical AI, thinking about biases, thinking about the impact of facial recognition. It's decisions and considerations that will shape the next few decades of our lives and our children's lives and our businesses.
And toward that end, it not being, charity, I know that Ritu has put in the chat that women-funded companies get 46% higher returns. And again, not asking you to confirm or deny, but I know that your track record is also at or above 4 times the capital that you have deployed in your 15 or 16 plus years as a venture investor, and that you're looking at an IRR of close to 90%, which is pretty freaking extraordinary. So congrats on that. And
it's a diverse team effort. It's a team effort, but yes.
It's a team effort, and then there's also individual track record. At any rate, speaking of individual track records, I'm gonna, Mike, I'm glad that you're here, but it caused me to look back and pull up an email exchange that you and I had in 2011, followed by an email where I was inviting you, or you were responding to an invite to Venture Crush in 2012. And you wrote, "By the way, I just left Walmart.com. I'm now the CEO at a startup in San Francisco called Stitch Fix." And I know you joined when there were 4 people. We ended up having dinner, soon after that. And part of why I'm reading that is what I should have said at dinner was, how do I angel invest in your new startup? And I feel like we talked about wine a lot at that dinner, and I never made an investment in Stitch Fix. And I'm kind of a moron, but I'm glad that you're still here.
You're not a moron. I would be a moron if I wrote CEO, because I joined as COO and I want to.
I said COO.
Okay.
I said COO.
Okay.
Yeah.
Cool. Because my boss, founder and CEO, Katrina Lake, is one of the most amazing people and leaders that I've ever had the opportunity to work with. And yes, that would have been a good investment for you, Ed. But you can be on the list of 50 plus investing groups that also said no to our Series A because we had a very, very hard time raising the Series A, and basically had a bridge from our seed investor to get to the A. So there were lots of people that also did not invest. You would have made the investment, but if you had heard more of the story, but there were lots of people that just were not fans of what we were trying to build back then.
Yeah. So can you talk a little bit about, you grew up in Virginia, you go into retail, and then you stay in retail, joining a startup that becomes this iconic and important startup. And in fairness, I didn't see the deck. I didn't ask for a pitch. I was doing angel investing at the time, so I am weeping, but it's all good.
It's all good. Yeah, I mean, my background, and first of all, thanks for having me. And it's like a very impressive group of panelists, and I can connect individual stories with like everyone on the panel. And I learned so much from these things. So I'm excited to be here. I grew up in Virginia, right outside Washington, D.C. Went to University of Virginia for undergrad. Similar to Phil, my dad told me there was no safety net. The minute I walked out of the house, it was like, just to be clear, son, you are not coming back here. So I was very motivated to get a job. I got a job in consulting, worked there for a few years, and then went to business school at Berkeley, moved out to California in 1996. And then I'd say 6 years of not really finding my lane, 2 years working on Wall Street, 2 years at a startup that was, I think is still considered one of the worst ideas from the dot-com bust. And it was like terrible from start to finish, and learned a lot about failure. And then 2 years doing corp dev at a software company and thought corp dev was the best job ever. We had a venture fund. It was like a $50 million fund. I was doing diligence on, companies. I was doing financial modeling, sourcing, loved that job. But the company itself got to a point where there just wasn't a good reason to have a venture fund. And certainly there wasn't a good currency to be active in M&A. And so my wife, who is way smarter than me, we sat down and had a family meeting, and it was, hey, we live in a very expensive town, the Bay Area, and it'd be great basically if you could keep a job longer than 18 months. Because it's really hard to live in San Francisco if you can't keep a job. And so I thought, well, I'll go to a place that was unlikely to fail, or I was unlikely to bring it down. And I went to Walmart.com in the early days when there were about 100 people at the division. We had just done about 150 million in sales and had an awesome 9-year run. Got to be chief operating officer of Walmart.com, went from 100 people to like 12,000 people. As COO, I was responsible for about 10,000 people, all the warehouses and customer service, et cetera. But was looking around and just realized I wasn't a big company person. I'm not a big company person, and got lucky in my next adventure, joined Katrina when we were just 4 people. I mean, she was definitely taking a chance on me because I was a big company person, joined as COO, and then also had a great 9-year run with Katrina and Stitch Fix. I did a bunch of different things at the company, COO, CFO 3 different times, and CEO twice when Katrina took full 16-week parental leaves. And now I'm an investor. It's so cool to be on call with these actual people that know what they're doing. I'm 10 months into being an investor and learning fast. Unfortunately, I have a partner, Nikhil, that is just an amazing person, but also an amazing investor that's helping me get up the learning curve pretty quickly.
And can you talk a little bit about founding Footwork and what you were thinking about? Because when you leave a job as big as the one you had at Stitch Fix, after the years you put in and the acclaim that company garnered, the press reports on your departure, and talks about what you're doing next. And then when you launch a big fund, as you did with Footwork, there's also all sorts of discussion about it. So can you talk a little bit about what made you found Footwork and why that, and not taking a job at another fund or some other cushy job that was available to you?
Yeah, I mean, there were a few dynamics. I mean, so Katrina and I had this amazing relationship where it was trust-based, and we both said early on in our relationship, if you ever decide you want to leave, Katrina, you need to tell me, and if I ever decide I want to leave, I'll tell you. And it was just like bonding right from the start. And so I had told her in middle of 19 that I probably had another year left in me before I wanted to go do something else. The something else wasn't super clear. I was either going to be sort of quote unquote board person. I'm very fortunate. I'm on 3 public company boards, 1 SPAC, 3 privates. It's way too many boards. It's super privileged. I feel lucky, but it's too much. But I could have, sort of gone down that path. I was lucky enough that I could have been, sort of just gone and been a CEO somewhere and helped build a company again, or a number 2 with a great founder. I don't have a huge ego about the CEO thing. But what happened was in 2020, there were a number of factors. One, I decided I wanted to stay in the tech ecosystem and have massive impact over the next 10 or 15 years. I wasn't ready to kind of, hang up my shoes, as they say. Another thing that happened, Nikhil, my partner, reached out to me and said, hey, would you ever think about starting a venture firm with me? Another thing that happened was George Floyd got murdered. And I just was like, what in the world is going on? And I looked around, and I sort of the combination of the ecosystem that I had grown up in sort of tech and startups and early stage, plus George Floyd, plus my partner who, we've showed pretty early we were aligned on core values and principles and what we thought was important. We started exploring starting a firm together. And we got super lucky. I mean, he's really, really talented. I've got a pretty good operating background. that we could draw on. But we announced that I was leaving in November of, I think, 2020. I left Stitch Fix in January of 21. And by the first week of March, on a $150 million target fund, we had 330 million of committed capital, which I understand when I tell the story, like people that have gone through really hard times, whether like Stitch Fix, where we had a hard time raising capital, or people that are raising funds, that is not normal. And we got very, very lucky. And I feel, sort of embarrassed of riches in ways of how lucky we got. But I think the biggest driver for me was the seat I got to sit in next to Katrina for 9 years. I got to see how an amazing founder kind of scaled from herself, and we scaled the company from 4 people to 10,000 people. And that's a very unique seat to sit in, with all the, pros and cons that come with company building. And on this, sort of spirit of diversity, I got to see how one of the most talented founders ever, in my opinion, as a young woman, got sort of was taken for granted, and people didn't respect how smart or amazing she was. And I do think there was ageism. I do think there was sexism. And I think Nikhil and I, as investors, now feel strongly that we want the ecosystem to be a lot better, and hopefully we can be a positive change towards that.
There's so much there, and I promise we're going to talk about the scaling, because it is extraordinary to be for you to have been a part of that, and we should all benefit from hearing more of that story. I want to push back a little bit on your comment that you were very lucky, and why it is that you have to have been lucky instead of other things for that fundraise to have gone that way.
Yeah, I think that's fair pushback. I mean, I was listening to How I Built This. A friend of mine had done kind of was on Guy's program in October. And I guess he always asked the same question about how much of it's luck versus skill. I don't know exactly the way he asked it. And I would say that, we were very intentional in terms of how we did our fundraising. I think that is skill and some talent, mostly Nikhil's. I think that our story of sort of investor plus operator combo, and how that's differentiated on the field today, and how we can really help founders, is also skill. I mean, I've been, lucky in that I've gotten to work at Walmart.com and had amazing support from leaders and mentors, and then gotten to be at Stitch Fix. But, company building is really hard, and going from 4 people to 10,000 people at Stitch Fix and no revenue to $2 billion in revenue in nine years is, you have to execute really well. And I think, as an operator, I was pretty good at that. So I think the story of Nikhil's track record and sort of my operating did resonate really well. And I think some of that is based on kind of hopefully some talents that we had, and we're able to express that well to our LPs.
Yeah, and I appreciate you allowing the pushback there. And sometimes people don't take enough credit for things, and too often in venture it's in the other direction. But in particular, over the weekend I spent a little time reading research, and there was a paper done in 2019 at Stanford that I did a thread on Twitter about over the weekend. And the paper, so these Stanford researchers combined with Illumin Capital, and they created 4 fictitious venture funds, 2 of them led by Black VCs and 2 of them led by white VCs. And they decided that they would show teams of 3 people for each of these funds, and that because there were so few Black VCs, the 2 associates would be white men, because otherwise the researchers actually wrote it would not have been credible. They did not tell the participants in the study that they were doing a study on race and bias in venture. and they literally just used stock photos and then swapped them so that it was the same bio, just with different faces. And they looked for bias, and the results were fairly extraordinary, because so they had two teams that were high performing and two teams that were low performing based on the track record of the lead. All of them were raising a fund 3 of the same size. And what they found was that the LPs were biased against the high performing Black manager, and the LPs were biased more favorably toward the low performing Black manager as compared to the low performing white manager. They still wouldn't give money to the low performing white manager, but they disproportionately didn't give money to the high performing Black manager as compared to the high performing white manager, even when it was, the same person. What's especially disturbing is that they then asked the LPs to evaluate themselves after reviewing these profiles. And after reviewing the high performing Black managers, the LPs, who in the study were predominantly white, felt worse about themselves. And after reviewing the low performing Black managers, the LPs felt better about themselves. And so there's an extraordinary amount of bias in the system. It's important to be aware of it. I'll drop a link to this thread, which also links to the research. But when you talk about being lucky in having garnered 300+ million, which would be the largest ever first-time Black-led venture fund, I think. There are very few Black-led venture funds over 100 million or 200 million. There are a couple over 300 million, but it's a really small number. The uphill battle against bias, despite or perhaps intensified because of high performance and actual numbers. And these, if you look at the research, they actually had IRR and TVPI in the documents. So it's not like they were saying, this is a good VC. It was, here's the actual numerical performance. So there's luck, and then there's a playing field that we know isn't level, even when people think it might be, because we're looking at math. And that's part of why I also wanted to shout out the extraordinary TVPI that that the four of you, or the extraordinary performance that the four of you have put up, because it's important to not just see the representation, but to also know that the representation has created real wealth. So I appreciate all of you for being here and being part of the conversation. And I'm going to open it up to all of you, and thank you for letting me focus on each of you one at a time. We can certainly talk a little more about that. And I realize I've just summarized a research paper, and you're welcome to react to it. I don't know if anyone wants, if one of the panelists wants to react to it.
The only thought I have is, Ed, that it's sad actually, beyond the findings, because this paper and this research seems like it was a 2019 work, and going back to 2000, so nearly 20 years ago, HBS had done something along the gender side. I don't know if anyone remembers the Heidi Rosen case study, where Heidi Rosen was a VC at SoftBank at the time, and they changed her name. Half the sections had Heidi's name and the case study, and half the sections had I don't know if it was him, I can't remember what it was, but it was a male name. And it wasn't from an LP perspective, it was how the person was perceived, how good of a VC he or she, depending on the case study, had been perceived, and very, very similar outcomes. And here we are 20 years later, and we see the same pattern along the background. So I think we have some work to do.
Yeah, I mean, we do. And, to what we were talking about, before, we've made progress and there's more focus on it than ever before, but we have a long way to go. And I think part of what that research points to is, at least what I found in the LP community, is some will focus on diversity. All right. And that's a diversity bucket. And then there's a performance bucket. And, it's not an or, it's an and, right? And everyone like on this panel speaks to that. And there are a number of others who look just like us who are putting up great numbers. And for whatever reason, those two, it's hard for folks to bring those together. It's happening more now than ever before. But I think that's part of why you see what that report demonstrated, right? So if you have, if you're looking at someone who, where diversity is the focus and it's not performance, then you're going to have a broader perspective of everyone who comes in the door. When you're looking at performance and you're not taking into consideration diversity, then all of a sudden you think that diverse manager, if they show up, you're looking at them, you think they should be in the diverse bucket as opposed to just looking at their performance that's before you. And so it's a real challenge. It really is.
Yeah, and as one of the VCs that we've backed through First Close said at one of these events last year, there's an LP who told her, "I'm sorry, we've used up all of our black dollars." And she immediately, without hesitation, shot back, "That's okay. I just want your green dollars."
Right.
And it is a fascinating. There is a fascinating opportunity if you are aware of and can overcome the bias against high performance. So it's extraordinary. So I want to talk a little bit about scaling the companies and how you're thinking about scaling when we're in this hybridized, like we think we're back to the office, or we might be soon back to the office. And some people like Addie are eager to get in front of as many people and be in person. And some people are, like, I'm never going back to being fully in person. So what are you seeing in terms of how companies are building and what's working?
I think there's been a lot of debate about this among companies about the right way to build teams, especially now that being either fully distributed or hybrid is a lot more acceptable. There's also debates on what function areas I think lend themselves best to fully remote work or hybrid work with, a lot of engineers and technical leaders, I think, quite passionate that it's important for technical teams to be in person together as much as possible. And I've honestly heard compelling arguments across the gamut. I'm personally a huge supporter of distributed teams, remote, as well as hybrid teams, as long as companies can figure out how to, from a first principles basis, build policies and ways for teams to interact in a way that doesn't disadvantage folks who are not in person, because you do miss the water cooler moments. We've invested in companies that are enabling this, companies like Oyster that are helping new businesses that have never hired remotely before do so in any country around the world. And I think that's a pretty cool enablement tool that means that more businesses will be able to do it. So I do think that personally, I believe more remote, more distributed will be here to stay. And I think that can be a real benefit for businesses that can now hire the best talent anywhere in the world. And it can really help democratize access to the best jobs for folks who are not just in Silicon Valley or New York.
Yeah, I agree with that. I would say, the only thing I would add is I'd say over the last few weeks, I'm starting to see more founders who are interested in, increasing the number of people who are in the office, right? So whereas before, I'd say 6 months ago, everyone was, sort of focused on distributed teams, mainly because, obviously everyone was working remotely. And to Addie's point, you have access to talent, around the world, right? And so, whereas before you were sort of limited by geography, Now you're not. And there's so many tools you can use to sort of leverage collaboration within the enterprise. But I would say, I'd say over the last month, I've started to see, some folks really starting to move to have people come back. And again, also to Addie's point, I think it depends on the role, because I think for certain roles, you will never be able to recruit top talent and have them in the office, specifically for developers, data scientists, et cetera. But I do like product, it'll be interesting to see how that evolves. Some aspects of operations. And so I think it's an ever evolving sort of experiment in some ways.
I think, were you going to say something, Regina? Sorry.
No, go ahead, Mike. I'll
Okay.
jump after you.
Okay. I mean, one of the things I think is underappreciated, especially as we kind of go through hybrid, is just raw leadership and connection. It is a lot harder. I found it a lot harder as an operator to lead over this medium and stay connected with people. And I would say that we're pushing our founders to be super intentional about, bringing people together in some kind of authentic connection forums so you can build trust. I think trust breeds where you can be more vulnerable with people. And I think vulnerability helps you progress and make faster decisions and make the better decisions. And I think all that comes down to, in my mind, how is a founder leading in this hybrid world? And, I'm seeking backing founders that might not be there today, but have the ability to just be great leaders kind of in this new world. And I think there's just an underappreciation for just leadership development as we have moved to kind of this new paradigm.
Regina, you were going to say something, and then I want to go back to the leadership. Go ahead, Regina.
Absolutely. So I would echo the general sentiment as I look at startups that are raising their first funding and how they are approaching the world. A couple of sort of trends. One, that when they're distributed, productivity is higher, but ability to sustain the productivity is mixed. And then secondly, hybrid means different things to different folks. So for some, it's literally we are a couple of times together in a given week, and for the rest of the time we're remote, to multiple satellite or multiple locations where the entire organization gets together. So it will be interesting to see how it sustains in the long term. But in as we transition in the post-COVID or COVID with us, whatever era, whatever we want to label it, the ramp up of a distributed team is faster and the productivity is faster. And then I think we shall see how it gets sustained. Although one fact, I don't know if the other panelists have found this, we find that the 20 and 30 sums are increasingly looking to be in person rather than remote. I don't know if it's because of the apartments being footprint on whatnot, but we've seen that need for the water cooler from a group of folks and talent that we would have expected to have been perfectly happy in front of their computers at home. So it's an interesting cultural dynamic, all of which ties to that word culture. It comes back to leadership, but what culture do you build? On the one hand, you've opened yourself as a founder and asked to back them to a whole new opportunity of talent pool in Kansas, in areas that might have had engineering talent, but you never fathomed before having a presence, and now you do, tied with overcoming the bigger, how do you drive that we are all at war and want to win, that drive, that burning platform that gets teams, to cross the chasm to success. How do you do that, whether it's through tools or through other mechanisms to build that culture in a distributed or hybrid environment?
In leadership, how do you, there are some interesting threads here, right? Because Mike talked about leadership. I see it's getting some traction in the chat, and obviously it's a crucial thing. Rudina's comment about kind of segmenting out people based on what Gen Z wants is different than what Gen X wants, and millennials. I'm not sure that we focus enough on how our workforce segments out by the kind of age categories, because there are really different numbers for some of these things. But let's start with the leadership piece, and how as investors you're also thinking about the founders, and like how important is their leadership of teams when you're looking at the investment? Are you looking at how they're leading with back to office, or how they're leading with how you build a culture when we don't know if we're going to be really back to office or partially back to office or hybrid? How do you evaluate them?
I can jump in really quick. I mean, we're very explicit in that we look for founders that are hungry and humble, know their business inside and out, and are talent magnets. And on the specific hungry and humble and talent magnets, we ask a lot of questions trying to understand, like, do you understand at the core that there's very little chance that you by yourself can build an amazing company that is going to achieve an amazing exit if it's just you? Like, if you don't share the stage, if you don't can't attract amazing people to come, join you on your journey. And we fundamentally believe that the hungry and humble part of it is key to attracting that talent. That if you have a huge ego and you aren't willing to share the stage and aren't willing to hire better than yourself, then it's very unlikely that you are going to build a big, amazing company. And so we spend time evaluating hungry and humble and talent magnet as a proxy for leadership. We do not expect that founder day one to be an amazing leader. I led large groups of people for long periods of time, and I still have lots of areas of development in my own leadership. So if you're, mid-20s as a founder of a company, like, you would likely need help and people around you that are committed to your development. And we, as kind of both the way Nikhil and I work, think we're very strong on this dimension of helping founders achieve their kind of business results and goals and outcomes, but also develop themselves as leaders that give them a better chance to have the former, driving amazing business results be true.
I would just say, look, +1 to what Mike said. And, what I would say to your point about hybrid, leadership in a hybrid world is even more important because it's a lot harder, right? So what we basically say is, look, when you move from being in person to then remote and now hybrid, the one thing we know is that the relationship between the employee and the employer is going to be a little weaker than it was, right? Because before, you were walking into the office, you were engaging with your colleagues, you had the water cooler conversations, you may see the values on the board, all those types of things established a tighter connectivity between the employee and the company. And when you're working remotely or in a hybrid fashion, that's going to be weaker. And so it's incumbent on the leaders to lean in, to be more intentional about culture, to be more intentional about management, to be more intentional, as Addie mentioned, about ensuring that folks that are at home zooming into the meeting feel like they're being, involved in that meeting. All of those things are hard to do, right? And so leadership becomes even more important in a hybrid world.
And to build on that, it's also very, very different, but also not different than other types of challenges that leaders and founders face. Hybrid versus in-person, distributed versus centralized may be a new challenge, but we've had them build companies in recessionary environments, as well as, wealth environments in boom markets where funds are available, in markets that are affected by regulatory changes that catch them midway through the journey of the company. So in many ways, this is a different type of challenge, but it's also tapping into the leadership characteristics that these founders have to succeed, which is particularly around the execution chops, as we call it, the ability to transform a great idea or a so-so idea into a great business. And that's the hustle, that's the ability to inspire. And particularly, again, given the geography element or, in person or not presence, how do you inspire or fellowship when you're not with that human dynamic there every day? It's one more facet of what a great founder and leader does.
And Addie, you highlighted a handful of attributes that you look for in great founders. This was in a recent interview. You talked about high integrity, transparency. Do people enjoy being around them? Are they a talent magnet? Do people respect and want to work with them? Are they full of themselves? Are they doing us a favor by getting on the phone with a brand new firm? Which I want you to talk a little bit about. And then loyalty, which you say is a really important trait in a founder because you've got a decade of work ahead of you. Is this someone who will also say to you as an investor, if you folks do the work, you can write another check in the next round? And I don't usually hear venture investors talk about optimizing for loyalty. And obviously, we've been talking a lot in the press about the Great Resignation. Can you talk a little bit about these attributes, and you can correct anything I got wrong there?
Yeah, certainly. No, you did a good job, and you clearly do your research, Ed. Yeah, so we think about a founder framework as a sort of evolving list of, and we call them attributes as opposed to sort of and it's a framework, not a checklist, because we never want to sort of have a box that we're trying to fit founders into. And we think that there are probably evolving attributes that we will see or come across or be inspired by in certain founders that we want to be flexible to include in our framework. There's a bunch of the ones you mentioned that we look for that we think make promising founders who can build really big businesses. I'll run through those quickly, but I do think that this point about sort of loyalty, being quality, good people is an important one. And there is a slight distinction between it being loyalty for the sake of a transactional nature of, well, we better make sure that this is a loyal founder who's going to give us, what we need if we do what we say we're going to do, but more just about, to your point, like the 10, 12-year relationship that we're going to have with the founder and wanting to make sure that we're values aligned, and that not just for us and how this founder will treat us, but that we're values aligned in terms of how this founder will treat their team members that they hire, their customers who they work with, and just having that integrity, which is, I think, just so critical to long-term success. The other attributes that we do think are important, and I'm very curious to hear what this group thinks or any pushback, things we're missing. The first is I would call a purposeful background. So having some reason for building the company they're building. What is a unique insight into why this product or company should exist? Perhaps it's relevant experience. Perhaps it's having a chip on their shoulder. Nothing specific here, but just what in their background makes them purposeful about what they're building. The second is, are they a visionary? Can this founder talk about what they're building in a way that is inspiring? Do they have a clear brilliance of thought, a real vision for what the world can or should look like and how what they're building fits into that? There's sort of a je ne sais quoi element of it, which is also scary to say, because if you can't articulate exactly what je ne sais quoi is, that's where I think bias can come into play. So we always want to be careful about that. The sort of, it when you see it, but again, being careful with it. One test we use for this quality is this someone that we're so inspired by? We might drop everything we're doing. Don't tell my LPs this, but to go work for this person. And so it's someone who just like meets that bar and just sort of inspiring you beyond what you were expecting. Then I think the third attribute is being commercial, having really strong commercial instincts. This is unfortunately where a lot of founders fall down pretty quickly, is they're incredible visionaries. They have a real purposeful background, but they really struggle to just make things happen and to actually find the ways to make money out of the business, beyond obviously just driving revenue, but just sort of the commercial ability to create a real business beyond just an idea or a set of PowerPoint slides. Execution is a part of this. Having or being able to build the right network to get things done is a part of this. Being able to hire a great team is a part of this. It all fits into what we call commercial. The fourth attribute is can stretch up and down. Someone who both can be at the high levels a vision, but also really get in the weeds, whether it's product because they're a product visionary, or the financials because they're really business minded. So someone who just knows all elements of their business, who's obsessive about it, and just really lives and breathes it, and can communicate that quite effectively. And then this final point is, as we were talking about, just being quality, good people, really good values, integrity, loyalty. One thing I've actually seen a lot of recently, I don't know if the other folks on this panel and call have, but it seems like there's a lot more either yellow flags and or stuff that goes unverified, that's happened in just the crazy pace of investing and new startups that have been created in the last couple years. And I've been pretty surprised actually by the number of deals or companies where investments are made and there haven't been super thorough references done on the founder, or where there hasn't been sort of a real examination of even just sort of what's been reported in the numbers. So that's something I think is it's a separate conversation, I guess, but an outcome of the pacing that's happened recently. But it's something that for us, if we ever catch whiff of something that could be a yellow flag, is sort of an obvious red flag.
Can you elaborate on what you mean a little bit by a yellow flag? Not that the numbers are misstated, but something else.
Yeah, it's something as sort of perhaps simple or inexcusable or justifiable as something a founder lists on their LinkedIn as a credential, or something they've done that ends up not being totally true, or is a bit of an exaggeration. It is listing a customer logo or a VC logo in a deck, and the customer hasn't signed with them. They're just in the pipeline, but has been represented as a closed customer, or it's a scout check from that fund as opposed to that fund actually investing. So it's the little things like that again, justifiable, there's reasoning, but that to us is just a question of, okay, if this is being sort of exaggerated, what else might be exaggerated here?
And while we're on the topic of overstating, it's kind of you to say that I have, done deep research, and I see Ritu has also said that in the chat. This is a strength, not of mine. It is a strength of our team, because one of the things that we do is we ask lawyers in our tech group to research each of you so that I can look smart. And it's a great way for them to also engage in and learn about, who's here, and to learn about the market. And so I want to acknowledge and applaud Fernando Berman, who's also part of our LATAM effort that I mentioned. Juan Soto at our firm is leading, and I'll come back to that in a second. And Claire Dronzek and Kelsey Repka and Brian Weiskow, each of whom did research on one of our panelists. They assembled it for me. I then did actually, read it, click some links, listen to some stuff. But it's so much better when you work as a team, build knowledge and share knowledge. And I appreciate all of them for doing that. And I mentioned Fernando because one ask I have of all of you here, we, as you know, we do a Venture Crush Africa Global, and I see my partner Rossi Turman, who is the chair of our Africa practice, which Raquel Smith and Deandra Chin and I co-founded with Rossi. So we do our Africa Global Venture Crush events. We also want to do more with LATAM and with Latinx founders in the States, which is different. And so one question that we had was whether people, and feel free to email me or put something in the chat, whether people would want a Spanish-led version that Juan would lead in Spanish of Venture Crush, or whether people would want an English language version that is focused on the LATAM and Latinx market within venture and tech. So we'd love to hear your feedback on that. More to come on that. And sorry for the detour, especially after the interesting topic of yellow flags, but would love to know, would love to hear reactions from Mike, Phil, Rudina on what Addie has just talked about.
So perhaps I will jump in. It's interesting, over all the years of doing venture, we all look for, whether, despite how we label them, we look for certain characteristics: the hustle, the vision, the ability to transform categories or create existing ones. When you go in early stages, we do overlaid with, we're an enterprise and security investor with AI. So some domain expertise is quite relevant on both the end markets of enterprise and security and on the AI and data science side. You find some interesting facets. For example, for us, about 70% of our founders are experienced founders. They may be first-time founders of a company, but they're experienced execs that have stumbled into the problem or lived through the problem in the industry and are now, tackling it. So there is some level of experience, more so, I would dare say, than if you were starting a consumer startup. And then we have another 30% that are first-time company, first-time founder, and different characteristics in terms of what we look in those companies. We look for the drive, and we over-index on the, I think, Adi, you referred to it as commercial. I refer to it as I did previously, the execution chops or the execution ability. I will do X, they say, in this amount of time, and they do X plus something in T minus something. Well, those are signals to their ability to deliver. Also, first timers, I have a soft spot for them. Don't tell experienced founders that, because they have the ability to reimagine the world in ways that experienced executives do not. So there's something valuable about that naivete, and I use that term in the best of senses, as long as they are, sort of leading the disruption, but the team that surrounds them or that they build around them drives adoption. So it's a first-time founder surrounded or coupled with experienced advisors and an experienced management team that they build. But we over-index for execution versus visionary. In the long run of doing venture, we've seen a lot of visionary with not a lot of ability to turn that into sales and traction and whatnot. Just like you see incredibly execution-oriented founders that would get an nth higher valuation and X something more had they had that cult-like, and again, I'm using the term, but in a good way, following and ability to inspire. So we look for both, but we look for disruptors and folks who can drive adoption, and then fundamentally ability to diligence. We haven't forgone it. Now, is it because we are so disciplined? Sure, I would like to claim that, but it's also the case that we stay out of the valley. In enterprise and broadly and AI, we have done quite well on the East Coast. We've done quite well in other regions of the US. I've never invested in the Valley. And so what that means is we don't have the same competitive dynamics in terms of oversupply of capital for early stage available to founders. So we have never compromised around diligence. Never say never. There are all sorts of ways that founders could overstate, I suppose, and any of us could overstate our credentials. But to date, we haven't stumbled into that, in part because I don't think we have sacrificed quality of diligence for expediency because of the market dynamics around term sheet and when term sheets get issued. I'll pause at that.
I was going to add a couple things to Addie's comment. So I don't think you can emphasize enough this yellow flag equals red flag idea. Like, I just think that that's just, I think that's the mindset we should all have. Some recency bias, but last night we passed on a deal just because the founder had represented an angel investor as being super excited about what they were building. I happen to know that angel investor very well. I call the angel investor and I get a completely different story from the angel investor on what they thought about the idea. And I was done. Like, it's just done. Like, that doesn't work for me to understand, like, where they say one thing about, who's on their cap table and what they think of the idea. And that's just not, it's just not true. And it wasn't like a miscommunication. It was the conversation between the angel investor and this founder had happened 48 hours before I had talked to the founder and then back channeled the angel investor. So like that just doesn't work for Nikhil and I. I would say the other thing is like, you know, if you're a founder and you're referencing any one of us, like I'm not saying that, you know, you can find people that don't like me and you can find my areas of development from people. But if most of the way, you know, Addie shows up or Phil shows up or I show up isn't positive, like you should never like take money from us. Now, fortunately, I don't know Phil really well. Addie references amazingly well. She's like she's a superhero from the people that I know that know her. But I do think it is the founder's job to do these back channel checks and kind of trust what you're hearing in terms of green, yellow, and red. And yellow should equal red, in my opinion.
No, I want to hear how you actually go back and tell the founder that you're now passing, because it's so hard. And one of the things that, and by the way, for disclosure of self-interest, through First Close and or personally, I am an investor in Mike's fund, Phil's fund, Addie's fund, and Rudina's fund. Not necessarily a coincidence, although with Mike and Phil, this is the third decade I've known them, and Addie and I met 6 or 7 years ago, thanks to Jan Hammer at Index, because I've been doing stuff in London and she was there. I mentioned that because the ability to check references is extraordinary and it's so important. And for instance, I see Andre Charu is on the call today, and Andre has a really interesting venture fund that focuses on, and Andre, you can unmute yourself if I get this wrong, that focuses on investing in Canadians, I guess especially, but not only if they come to the States. And I got a tip about Andre's fund a couple of years ago from my friend Alfred Lynn at Sequoia, who thinks incredibly highly of Andre. And as we're on the phone flipping through, or on a Zoom flipping through his deck, I see Hans Tung from GGV is in his deck as an advisor. And so I text Hans and get the reference back during the call, and then realize that a former student of mine sat on the board of his company. And it's really important to me, particularly, and this goes back to the comment about Rudina's 2017 article, it's really important to me to know that the men that we're backing have treated the women with whom they have worked really well and have created inclusive environments. And so, this former student who remains close to me and who's an LP in First Close, I won't give her name, but she was a GP at a fund. She says, yeah, sat on his board. He's created an extraordinarily inclusive environment. That is a red flag for us if someone has not. So during the one phone call in 30 minutes, I'm able to get those reference checks, because Andre in this case was deeply enmeshed in this venture world. It's harder perhaps when someone isn't, and we should never pull the ladder up. But for me, if someone has been part of creating a non-inclusive environment, that's a beyond red flag. We're done. How do you report that back, right? And thank you, Andre, for being
Thank you for
here.
the comment and for the shout out, Ed. And you are an incredible referencer, by the way, for doing that on the call and all the other references I heard that you did to make the decision on investing in Maple. I'm very grateful, but you are really good at referencing, and I've actually learned a bunch from you on that as I make my own investments in companies in terms of the speed at which we need to make investments in the current environment. So it was pretty impressive how you did that on the call.
Really kind of you, Andre, and thank you for letting us invest. But how do you give that feedback then, or then do you ghost them?
Yeah, no, it's a really good question that I'm dealing with real time. I sent a pretty indirect message saying we're passing because it's too early. That was the primary reason. The guy came back and said, I'd like to go deeper on this. In our deeper, I'm going to give him 15 minutes and I'm going to tell him what I learned. because I think it's important. I did not feel like I should tell him over email. It wasn't sort of a good medium to say that. And I frankly didn't have any relationship with him to sort of feel like, you know, hey, if it was like someone I'd worked with in the past that they were misrepresenting or stretching kind of what they did, I always call them and tell them, hey, I heard you're saying this, like that's not what you actually did at Stitch Fix or at Walmart. But I do think the feedback is super important. I just think a lot has to do with where are you in the relationship kind of spectrum with that person. But my wife, like who works at home too, says, I can't believe you said that to a founder on a call. And her example just last week was, I was telling a founder like that we look for hungry and humble, and that I didn't experience them as very humble in our meetings. And she's like, you just told them that? I go, yeah, why would I not? Like, you know, they don't have to be humble to like raise capital. They just need to be humble if they want to raise capital from us. I'm not sort of passing judgment that they're a bad person. I just think that I want to be clear on what we're looking for. If you want to know what we're looking for, then be honest about kind of what the sort of match is between investor and founder. So yeah, I'm in the middle of it, but I do think I just organically have, some would say, a challenge in that I give very direct feedback, even if it hurts, because I wanted that in my own development. I was only going to get better if someone really kind of invested in me to give me really good feedback on what I was good at, and then other feedback that I needed, where I needed to improve.
Others on this point and reactions?
Yeah, and I agree. I mean, I think it's critically important. And I think that, you know, both in terms of feedback to, you know, folks in your portfolio, folks you do diligence on, or even folks that are just engaging where you might not engage in the deal. I think as VCs, you know, sometimes, you know, we don't always provide transparent feedback. And I think that makes it hard on the founder side, right? Because we're not providing transparent feedback on where we are in the deal process. We're not providing feedback, you know, on why we passed. And these are all learning opportunities that I think are missed. And so I 100% agree with Mike. And also, I think to Addie's point on the yellow flags, I do think they've increased. And I think it's partially a function of where we are in the cycle. You know, we're sort of out on our skis in terms of risk appetite right now, I think, as a venture community, and that plays into it. I think deal velocity, this is faster than I've ever seen since I've been in this business. I think the fact that a lot of diligence is being done virtually plays into it as well. And also that it's being done globally. Like when you think about deals, again, 5-10 years ago, they were sort of concentrated in the Bay Area and New York. Now they're everywhere. And it's becoming harder to sort of do that deep diligence quickly, given timeframes for getting deals done. So I think that the yellow flags have definitely increased.
One other thing I would just,
Please.
oh, sorry, go ahead.
No,
One other thing I was just going to chime in on quickly is the other, totally agree with everything that Mike and Phil said. And I also think honesty with co-investors, especially if you know the seed firms who have invested and who have sort of been supportive of you getting involved, or other folks around the table, is also important, and something we've had to think about when we have had to, like Mike, pass on deals where we've learned something that is a yellow flag for us. And they're awkward conversations, but I think if handled, the more transparency I think that you show with others, I think the more that co-investors and founders actually ultimately respect you. And those that don't, like Mike said, they're probably not the founders or co-investors for you.
I'll take a slightly different view on this, in that most VCs don't give direct feedback, not because they don't want to give direct feedback, or maybe they don't, but because we need to be liked. I mean, what is it? 95% of the time we're saying no to deals, and we need these founders to like us and want to work with us and come back again. So before we talk about how we build goodwill with these founders through honesty and transparency, I think it begs a question as to why do most VCs say, you know, instead of saying, I would never in a million years invest in this business for 1, 2, 3 reasons, say, please give me 2 to 4 quarters more traction and come back to me. I tell founders, that's a solid no. Don't go killing yourself for 2 more quotas to try to prove folks wrong. Is because, you know, we're in the business of saying no, and we're in the business of needing these founders to work with us over and over. So the approach, at least I personally take, is very candid. Sometimes mid-conversation, it becomes very, very clear that we are not a fit for each other for whatever reason. But then pause back and say, what is the one thing I'm going to do for this founder to genuinely help them, rather than give them advice? Or here's my thoughts. Is it an introduction to somebody else? Is it a better, you know, even if you know, which you never do, in a million years, you will never beg that person. I cannot tell you how much goodness comes around that. So it's not just about being transparent, as honest. It's about going the extra step of, how can I be helpful to this person? We all raise funds. We know how hard and disruptive fundraising is, especially, you know, in the early innings of one's career. So what can we do, that extra thing? And, you know, in turn, they introduce you to other founders, that there is a goodness that comes out of it. And this is not too different, not to take this in a different direction, but once we have made the investments, is the courting that goes on before you make the investment, and then you are in the real marriage, you know, once you've made the investment. I tell the team every, you know, partner meeting, when on Mondays we do new deals, on Fridays we review the portfolio. Before we start giving update on XYZ company, what have we done this week for them? Sort of this mindset of the dollars and the board seat doesn't entitle us to their respect and to the ability to give hard feedback. We have to earn it by how we help them. At the beginning of this conversation, we talked about sort of founders being one's best reference in the context of Addie, and I cannot stress that enough. I mean, one of the things we report to our LPs is how many customers we've closed for our founders and our portfolio companies, how many execs have we recruited, how many diverse, you know, folks have we brought at the board, management, whatnot. So the adding value is now a metric rather than, oh, we're going to be so great. Furthermore, we have founders that are prospects that we're evaluating, reach out to our founders. Like, we make it a criteria that we will not issue a term sheet unless they've talked to 3 founders of our choice anytime in our careers. So it's a really well balanced, but transparency, I think, and hard feedback comes with responsibility of helping in not in a charitable way, and in the doing the right thing manner.
You know, I want to use this as a departure point to talk about the difference, because I love that you mentioned, you know, VCs want to be liked. And there's a comment that Mike made about, you know, you can find people who don't like me, and, you know, people who will talk about my areas that need development. There's a really big difference between being liked and being likable. And I definitely want to work with people who are likable. I'm okay if those people have a bunch of people who don't like them. And the example, and I wish that we would lean into this a little bit more. I was in a room recently where we were discussing whether, you know, someone who publicly misbehaved, like how to think about that. And one of the comments was, well, you know, no LPs at that fund said anything publicly. And it underscored for me the importance of calling out misbehavior. And, you know, Rudina, when you talk about the references, and I haven't done references on Addie because I've been a reference and known so many, you know, we know so many people, and I've been involved in what you're doing for so long, Addie, as an example. But the receipts, showing the receipts, like, yes, we have introduced other, you know, diverse board members, and yes, we have introduced customers. Keeping those receipts is really important. And I'm going to drop a receipt in the chat, because, you know, one of the things in something that Rudina wrote, this article in 2017, she referenced this statement from the New England Venture Capital Association. And it's a statement against discrimination and sexual harassment. And I say that because how freaking hard is it to denounce discrimination and sexual harassment? There are like 35 venture funds that sign this thing. There's one LP. and it's Tiger Iron. Tiger Iron Capital, and it's Rebecca Connolly. And at the time, that was less than a 2-year-old fund. Why in New England, where there are so many institutional LPs, did only one fund, in one LP and 30 some odd funds sign on to this, right? Like, how do you do that? How do LPs not stand up and say, this is wrong, this is something that needs to happen? And I mention this because it's okay to not be liked by the people that you're calling out because they've misbehaved. I'm not saying that you have to cancel them, and obviously there are nuanced situations, but there are situations where someone has defrauded people, or where someone has been a serial creator of hostile work environments, or where someone has seriously misbehaved. And too often we sweep it under the rug, and too often we are unwilling to take a stand. And because we're unwilling to take a stand, and because we want to be liked and think that the right way to be liked is to not make a fuss about someone's misbehavior, that misbehavior is permissioned. And it's okay to not be liked. It really is. And it's okay to make a public comment about something that happens that is fundamentally wrong. So I just, in terms of like, when I think about the culture that I want to be part of and with whom I want to work, I think that those things are important, and the difference between likable and liked is something that I would like us to think about a little bit.
And if I may add to that, 2 thoughts related. One, we've taken the point around diversity and what you are referencing. It's actually a binding term in our term sheet in our legal docs. So it's putting substance behind your claims. And also, I will reference what at the time felt like a very painful, but at no point did we question the decision. When Black Lives Matter took full steam in 21, Glasswing took an open stance. So we put our position out there pretty forcefully, and we had a very large single family office LP in the final stages who saw the world very differently than we did. And we made, again, tough decision from an LP commitment, but we walked away from a very, very significant LP commitment because we saw the world differently. And I share that not to say, oh, poor us, we're fine and we're quite happy with where we are, but that it's easier to preach. We've got to leave what we preach, both in terms of who we are, who we back, and who we take capital from.
Completely agree. I mean, I think calling out, and misbehavior, as you mentioned, is something we all have to do. I would say the other point, though, around being liked versus likable. I mean, I will say, not all my founders are going to like me all the time, because there are going to be times where, we're going to have a difference of opinion. And my job, my role is to convey that authentically. And, that's not always going to lead to my founders loving me. At the end of the relationship, they tend to, when you reference me. But, our job is to be direct and to provide our perspective and be as supportive as we can in helping them to build their businesses. And, to the notion of value add, I mean, that's part of being a value add investor, right? And so I just want to make that point as well. It's not always going to be a kumbaya relationship. It's just not the way it works.
Okay, so the research that we did in advance of today is research that founders can do on you. These are, I mean, I know you folks, but there's a lot of stuff that's publicly available. How often do founders, for a first pitch meeting, this goes back to the issue of raising money, come in having done a whole bunch of research on you and how important is it for them to have a good understanding of the value you are likely to provide and of your funds?
For us, it feels like, I'll start, sorry, 75% of the time they've done some research on us. And it doesn't, we don't care as a ego stroke, we care as a, let's quickly figure out if there's founder investor fit. That's the only reason we are impressed with kind of why they might want to work with Nikhil or I.
Yeah, I
So-
often find that it's, oh, sorry, Phil, go
No,
ahead.
no, please go ahead. Go ahead, Eddie. I'll jump in after.
Usually it's when a founder has heard really, really good things about us and what we've done with another founder who's made the introduction, and or one of our co-investors who's seen what we do firsthand, even if they don't sort of extensively know Avid, because we are a newer firm, just having heard, at least, again, it comes back to references, that coming in really lays the groundwork for them to be quite open in the course of the meeting. So I think it can be even just individuals or anecdotes to create the openness.
Yeah, I mean, similar, I think I was thinking 75, maybe it's 50-50. Often they've done research when they're referred. If they haven't done research, we often encourage them to, similar to what Rudina mentioned, because, as Addie mentioned early on, I mean, it's a marriage, right? It's a 10, 12-year relationship. And just as we're doing diligence on them, we highly encourage them to do diligence on us.
And three of you worked at venture funds before starting your own fund. What did you take and what did you not take in terms of the culture that you're trying to create or that you have created for your current fund as compared to the funds that you had previously worked at?
I guess I can start. What did I take? I'll name one on each side. So in terms of what I took that I want to make sure Ardent embodies, it's the value add piece. So the fund I was with, Novak Biddle, early stage fund. So pre-seed, early A, often first check, always lead, always board seat. And we were the most active investor in the investment. And, that's what we strive to be here. We want to be the first call of the founders that we back. And so that culture of just being tirelessly, working for our founders is something that I seek to embody in this firm. I'd say the one thing that we're probably doing more of that we didn't do as much with my previous firm is just being super intentional about the ecosystem. So just in addition to, being focused maniacally with our founders, at Ardent, we're also trying to do the same with our co-investors, with some of the seed investors that we're working with, and just really being intentional on that side as well. I'd say with Novak, we sourced most of our deals. We had a broad range of folks that we partnered with, and with Ardent, we're trying to be a bit more focused in that regard.
I would say for Glasswing, and what's different than previously, we've taken this notion of being the most trusted investor, the one that is an extension to the management team and rolls one's sleeves to a whole new level. You referenced platforms at the beginning of this chat. So for perspective, we are, with 2 funds under our belt, early stage firm, we have a team of 14. Including, venture and operating partners that are former CROs, former CTOs, former CMOs that are helping in the go-to-market phase. So a lot of investment upfront in building a team that's really formally and in a systemized and programmatic manner supporting the companies. Again, how do we shrink that go-to-market? How do we help the companies cross the chasm, not just simply to get into revenue, but the right logos and the right kind of revenue. That I think on a relative basis, we have taken to a whole new level. I think we've stuck to, being active board members and being involved, but with a lot more notion of how do we embed ourselves in the ecosystem and how do we bring the ecosystem to us. So, we do all the things that all of us do around conferences and networking, etc. But like, I'm still on faculty and staff and at HBS, and I don't teach. I've never taught. I've never gotten paid. It's all about being closer to the university ecosystem. My partner Rick does something similar at MIT. Our partner Sarah with all of the university ecosystem around DI. Our partner Sarah Fay, in addition to investments, really champions that, and all our work with the UNPRI. That is much more purposeful, and we were doing that ad hoc previously, as well as she co-chairs All Raise. She's our star in changing the world, and then perhaps lastly, in terms of how we view the ecosystem and what we do, is looking at how many repeat founders can we back, and how many of those founders are coming back to us. Our number one criteria, besides the returns we generate and how we make money for our LPs, and then ethics, is really the repeatability of our founders. Right now, we're at about 52% of founders that we have backed, we are backing and have come back again, because ultimately that's the proof of we've done right by them, we've made money, and we're the partner of choice amidst a lot of options. So we look at that as an output.
Great. Addie, what'd you take? What do you want to leave behind?
I think a lot about this from a culture perspective, culture and team building. So I feel very lucky. I've gotten to work at 3 phenomenal institutions: Goldman Sachs, General Atlantic, General Catalyst, and there are elements of the culture of each of them that I've loved. The striving for excellence and mentorship of Goldman, the focus on philanthropy and doing good at GA, and really just the familial aspect and real founder first approach of General Catalyst. All are things I've tried to pull in. And as I alluded to earlier, I also very much believe in building teams and cultures with a real focus on the people and the personalities of who you're bringing in, being reflective of the sort of the brand and the culture. And for me, keeping teams lean and not growing for the sake of growing are a really important part of ensuring that the culture and brand sustains, and that we can stay true to our values as we grow.
And Mike, the last word. Don't feel that this is like, it just has to be great. It doesn't have to be brilliant, just great. Culturally, at Stitch Fix, what do you think really were a couple of the things that led to greatness?
A few things. So we were very intentional about what we hired for, which was bright, kind, and motivated by challenge. We were also open to sort of evaluating whether bright, kind, and motivated by challenge were the right principles to hire for. It used to be bright, kind, and I think goal-oriented. And we changed goal-oriented to motivated by challenge because we found that people went from A to B, but didn't care about the collateral damage that they might sort of create from going from A to B, or didn't appreciate the ambiguity of the journey of all company building in a hyper-growth environment. And so I think we were willing to change and not be so dogmatic about kind of what those principles were. And then the last one was, we taught those principles. We taught our core values. We taught our leadership principles. We had the leadership team teach them. Nothing against, we had an awesome L&D team or learning and development team, but the senior team taught those principles. And I think that sort of showed we cared about these more than just a poster on a wall, and that we held ourselves to that standard as leaders. And we cared deeply about teaching the principles coming from the top down.
Can you quickly give an example of how you taught about those other than just repeating them?
Yeah, I mean, we had a class on our leadership principles, and we would talk specifically about what ACT meant, what inspire meant, what trust meant, what learning meant. And we would give examples in our own development where we failed in things like ACT. We would talk openly about like what our strengths were on our leadership principles. And we sort of talked about, gave very tangible examples of what great looked like on all those leadership principles as an example. And the leadership class was typically 4 hours for people to go through that I would teach, or Katrina would teach, or the senior execs would teach.
Love that. And would love to see people teaching on those values. It's something that it's something that I don't do enough of, and that we've been discussing as a senior team at Lowenstein. Well, I appreciate each of you for talking openly about these things, and for sharing your insights for 2 hours with a few hundred friends. So thank you very much for giving generously there, and really also appreciate all of the folks who make Venture Crush happen. Carrie Fisk, Katie Davey, Brittany Harlos, Jenny Amador, Angela Brondum, Betty King, Carolyn Doherty, Ginny Wagner, as well as my colleagues I mentioned earlier who did the research, and that's something that we rotate through our group. Would love to hear more from those who are interested in Latinx and LATAM market, and also if you're interested in our Africa Global stuff, we are doing a lot, and I have for several years, and Rossi has for 30 years been doing work on the continent. So feel free to reach out. And thank you all for joining us, and thank the 4 of you for participating, and frankly for letting us also invest. Have a great day, everyone. Thanks so much.
Thank you for your support, Ed.
Thanks, everyone.
Thanks, everybody.
Thank you. Appreciate it. Bye.